Hey, what's going on, traders? So my name is Bo, and in this video I want to go over the long straddle and also strangle because they're similar trading setup. Now this is very interesting because actually I see a lot of people now doing straddles or long straddles and long strangles. And I actually checked out some of my website analytics, and it seems like people are actually utilizing the long strangle or searching for long strangle a lot more. And I think I understand why, because the purpose, actually, first off, let me go into Option Scout and explain this to you. So let's go to long straddle. So the difference between a long straddle and long strangle is very slight. So a straddle is when you're selling a call and selling a put at the same strike price. The only difference between a straddle and a strangle is you separate those strike prices. Okay, so you can see that straddle is going to make like a little V, and long strangle is going to make a little like dip like that. And traders will typically utilize this strategy in a high volatile market. So that's why you see that happening a lot right now, where you have the whole CPI data where we don't know which way it's going to go, but it's probably going to go up or down a lot. Like, it's been very interesting to see the market right now where you see SPY will just easily go up 3% a day, which is very uncommon for SPY, but can also dip 3% as well. Which is quite interesting. So I think a lot of traders are kind of playing those games. So let's go over this right now. Let's do a straddle, and then we can take the straddle and extrapolate it to a strangle as well. So yeah, let's go into this. So again, so you're buying and selling at the same time. And then also what I want to do, I also want to show you how you can make this more of a bullish or bearish bet. Also, do keep in mind, a lot of traders who utilize a straddle or strangle are not usual, and again, this is not like financial advice, this is just like what I've noticed is in opinions of mine. Generally speaking, a trader's not going to go like do this trade and then go to the gym, go play some basketball, go hang out with family, and look back later. Like, this is not a passive strategy. This is usually like, I'm going to watch it, do this in the morning, boom, boom. And you'll see that quite a bit through volatile markets, is that the trade from the morning till like 2 hours after is really high volatile. So it's this is definitely something I think a lot of day traders will like as well. So yeah, so let's go over this, right? So practically what you're going to do, you're going to buy a call and buy a call and buy a put. So this would be the straddle situation. Okay, so you can see it makes this little V right here. Okay, that's straddle. Now, actually, I made that a little bit of a strangle, so it's supposed to be 138, 139. So let's do that. Yeah, so now it should be exactly a V. Now, if we want to make this a strangle, you're going to separate these. So now here's the thing. To make this more bullish or bearish, you're just kind of choosing which strike prices you want to on the calls and puts. Now, generally speaking, doing this in a week option would be pretty risky. So let's say you want to do it November 18th, a month out, or let's go a couple months out, because like it seems pretty clear that let's go December 16th. It seems very clear that the market's like waiting for something. It's like waiting for the CPI data to just completely be unexpected, either in a way that inflation went way lower, way higher. And once you see that happen, it seems like the market's going to go up or down in a certain direction. So let's say we do that, right? Let's take the let's do a 150 call, and let's do a 125 put on Apple. All right. So this is like, all right, if Apple goes to 110, we're making money. If Apple goes to 170, we're making money as well. And let's kind of extrapolate this. So you're making money on these sides, right? So you have two break-even points. You have a break-even point on the downside and a break-even point on the upside. So here, and you have a probability profit, which, yeah, that makes about sense. That makes a lot of sense, right? So you can see your max loss is limited, and your max loss and your net debit's going to be the same, right? That's just because the price you're paying is a long, you're not selling anything. And this is 0.4 delta, so that's definitely a little bit risky, but that's also taking the average. But anyhow, let's take this. So this is when you start to make money, and this is when you start to make money. All right. So that's quite interesting, and that's practically it. So in another way that a trader will utilize this strategy is when they're trying to buy low volatility and sell high volatility. So when would this make sense? Maybe someone's tried to anticipate an earnings play. Maybe they're like, okay, Tesla's earnings are in a couple months from now, or like in a month from now, and the earning date is going to be here, and it seems like the market is not really pricing that in yet, so let me buy up some strangles right now and hope that it goes higher because people really anticipate that. Or in times of uncertainty, right? Doing and here's the thing. It's a little hard strategy to make money from because you need a big boost, right? Like you're looking at here, your break even's 158 on the upside. It means Apple's got to go $20 up, and your break even is 116 on the downside. So Apple's got to go $22 down. That's a big increase. If we do the math, what is that? 15, 20%, right? You have to take 158, 10%. Yeah, it's a pretty good chunk. So it makes sense in times of, let's say, the market is clearly correcting right now. If we go back, this would have made sense if we could pull up a stock chart right here. At Option Scout, we have trading view charts embedded. Everyone knew that the recession was coming. The talks of the recession probably started. It was it was in the summer, really, when things happened, right? So around this time, you definitely probably would have made money if you did a long, great to test this out, but because it's dipping so much, and maybe, who knows, we'll see in the future now that maybe, just maybe, that it's going to boom again. So it doesn't, not a fortune teller, but yeah, during those times it makes sense. So yeah, that's a long straddle and a long strangle. So again, just to recap that, the difference between the two is they're at the same strike price if it's a straddle. So you can see that V shape. Also, you can adjust the range here if you want to, and then it turns into a strangle when you extrapolate these out, okay? And it's much harder to make money when it is a wider range. So if you bump these in, you don't need that much of a push, but it's still, generally speaking, it's high risk, high reward strategy, essentially. So anyhow, if you like this video, I'm making a lot of content on options trading, so please subscribe down below, give it a like. I have other videos about options trading as well. Check out optionscout.com to get, be able to a free option visualizer tool where you can track and trade your strategies and things like that. Well, you can't trade with inside Option Scout, but you can visualize your profits and everything. So anyhow, I'll see you in the next video.